What is happening, crypto fam? Get ready to dive into the absolute latest, the most explosive updates that are shaking the foundations of the digital asset world. The news cycle is moving at lightning speed, and if you're not plugged in, you're missing out on the seismic shifts happening right now. We've got groundbreaking institutional moves, major market indicators, and strategic plays that could redefine the future. This isn't just another day, it's a pivotal moment, and you're getting the inside scoop first, right here, right now. Prepare to have your mind blown as we break down the critical developments you need to know. Let's go. First up, a titan of traditional finance is making waves like never before, quietly becoming the undisputed heavyweight champion of crypto custody. We're talking about a massive shift that sees them overtaking the very exchanges that built this space. Is this a sign of mainstream acceptance or a new era of centralized control? You won't want to miss this. Then, we're diving deep into the numbers, comparing the king of crypto to the king of metals, and the results might just surprise you. Is one being criminally undervalued compared to the other? And what does this mean for where the big money is flowing? Get ready for some eye-opening financial analysis. Next, the political arena is colliding head-on with digital assets in a move that could have massive implications. We're talking about a high-stakes push into the heart of traditional markets, blending political power with groundbreaking financial innovation. What does this mean for regulation, adoption, and the future of crypto's political standing? And finally, we're pulling back the curtain on corporate strategies, revealing how major companies are planning to hoard a significant chunk of the total supply. This isn't just about holding assets, it's a strategic play that could reshape market dynamics and treasury management as we know it. It's all happening now, so strap in. Don't forget to hit that like button, subscribe for more, and ring that notification bell so you never miss an update. Let's get into it. A financial giant dominates crypto custody. The landscape of cryptocurrency custody is undergoing a seismic shift as a major player in traditional finance has now surpassed key exchanges in the volume of digital assets held. This development signals a profound change in how institutional investors are accessing and securing their digital assets, moving away from the platforms that initially defined the crypto space towards more regulated and established financial vehicles. BlackRock's iShares Bitcoin Trust, a regulated exchange-traded fund, has rapidly amassed an impressive 745,357 Bitcoin. This figure now places it ahead of major crypto exchanges like Coinbase, which holds approximately 706,150 BTC, and Binance, with 584,557 BTC in custody. The trend was further underscored in August 2025, when U.S. Bitcoin spot ETFs collectively saw a net outflow of $126.7 million from crypto exchanges. During this period, BlackRock's IBIT saw a significant inflow of $24.6 million, while other ETFs and exchanges experienced declines. This move towards ETFs is not limited to Bitcoin. BlackRock's iShares Ethereum ETF has also shown remarkable growth, accumulating 3.6 million ETH. While this still trails Coinbase's 3.8 million ETH and Binance's 4.7 million ETH, BlackRock's aggressive accumulation strategy, adding 1.2 million ETH in less than 2 months, suggests it could soon overtake Coinbase. This surge in ETF holdings reflects a broader institutional preference for regulated products, offering a perceived higher level of security and compliance compared to direct custody on centralized exchanges. The implications of this shift are substantial. Declining inflows into crypto exchanges, with Bitcoin's 30-day moving average inflows hitting a low not seen since May 2023, and similar trends in Ethereum, suggest that investors are increasingly less inclined to sell their holdings. This reduced selling pressure, coupled with the significant accumulation by ETFs, points towards a tightening of market supply. Such conditions are often seen as supportive of potential price increases, with current market levels around $111,000 for Bitcoin and $4,600 for Ethereum potentially seeing further upward momentum. BlackRock's ascendancy as the top institutional custodian for Bitcoin is a clear indicator of traditional finance's deepening involvement in the cryptocurrency market. This integration is reshaping the market structure and investor behavior, lending greater legitimacy to digital assets as a distinct asset class. The trend highlights a growing comfort level among large-scale investors with digital assets when offered through familiar and regulated financial products. But is this the whole story of institutional adoption? Get ready, because the next update reveals a surprising comparison between Bitcoin and a long-standing store of value. Bitcoin's hidden value compared to gold. Recent analyses are highlighting a significant disparity in how Bitcoin and gold are perceived and valued, suggesting that Bitcoin may be considerably undervalued when measured against traditional benchmarks. This discrepancy, particularly concerning Bitcoin's potential as a digital store of value, is increasingly influencing institutional allocation strategies and sparking debate among financial analysts. The core of the argument lies in comparing the total addressable markets and the perceived scarcity and utility of both assets. Gold, with its millennia-long history as a store of value and its widespread use in jewelry and industry, commands a significantly larger global market capitalization. However, as Bitcoin matures and its network effects grow, proponents argue that its digital scarcity, robust security, and increasing adoption as a medium of exchange and store of value position it to rival, if not surpass, gold's traditional role. Analysts are pointing to several key metrics. Bitcoin's fixed supply cap of 21 million coins, contrasted with the ongoing mining of gold which increases its supply, makes Bitcoin a more predictably scarce asset. Furthermore, Bitcoin's divisibility, portability, and ease of transfer, especially across borders, offer advantages over physical gold. Despite these attributes, Bitcoin's market capitalization remains a fraction of gold's estimated market value. This valuation gap is prompting a reevaluation of how institutional investors should allocate capital between these two assets. The implications for institutional allocation are profound. As more institutions recognize Bitcoin's potential as a digital gold, a hedge against inflation, and a reliable store of wealth, they are likely to shift a portion of their gold holdings, or at least a portion of their alternative asset allocation, towards Bitcoin. This reallocation is not just about chasing returns. It's about diversifying portfolios with an asset that offers unique properties and significant growth potential. The narrative of Bitcoin as digital gold is gaining traction, supported by its performance during periods of economic uncertainty and its increasing acceptance by major financial institutions. While gold has historically served as a safe haven, Bitcoin is emerging as a modern alternative for investors seeking digital diversification and protection against currency debasement. The ongoing debate centers on whether the market has fully priced in Bitcoin's potential, or if there is still significant upside as its role as a global store of value solidifies. But what happens when the political world gets involved with digital assets? Prepare yourself for a story that bridges the gap between Capitol Hill and the blockchain. Political power meets digital assets in Nasdaq push. The intersection of politics and cryptocurrency is taking center stage as a notable digital asset company, reportedly backed by the sons of a former U.S. president, gears up for a significant move into traditional financial markets. The company's ambitious plan to list on the Nasdaq exchange post-merger signifies a growing trend of integrating digital assets into mainstream capital markets, albeit one that comes with its own set of political and regulatory complexities. American Bitcoin, the firm in question, aims to leverage the Nasdaq listing to enhance its liquidity and attract a broader investor base. This strategic maneuver is part of a larger movement where digital asset ventures are seeking the legitimacy and access to capital afforded by public stock exchanges. The involvement of high-profile political figures associated with the company, however, injects a unique dynamic into this process, drawing attention to the potential influence of political ties on financial innovation and market perception. The path to a Nasdaq listing is fraught with regulatory hurdles, especially for companies operating in the cryptocurrency space. The U.S. Securities and Exchange Commission, SEC, will need to scrutinize the merger and the company's operations closely. Any delays or complications in the approval process could significantly impact investor confidence and the firm's market entry strategy. Analysts are closely watching how the company navigates these regulatory challenges, particularly in an environment where the SEC has shown increased vigilance towards crypto-related financial products. Furthermore, the broader cryptocurrency market remains susceptible to volatility, influenced by macroeconomic factors, regulatory pronouncements, and shifts in investor sentiment. While a Nasdaq listing could provide a more structured and regulated environment for American Bitcoin, it does not insulate it from these market forces. The company's success will depend not only on its ability to manage regulatory compliance, but also on its capacity to demonstrate consistent performance and robust corporate governance in the face of market fluctuations. The involvement of politically connected individuals also raises pertinent questions about regulatory independence and market integrity. While such associations can generate significant visibility and potentially attract investment, they can also invite closer scrutiny from regulators and the public regarding potential conflicts of interest or undue influence. The market will be keenly observing how these dynamics play out and whether they set a precedent for future political involvement in the digital asset sector. This development underscores a critical trend: the increasing convergence of political influence and financial technology. As digital assets mature, their integration into traditional finance is becoming more pronounced, blurring the lines between political power, financial innovation, and regulatory oversight. The success of American Bitcoin's Nasdaq ambitions will be a key indicator of how effectively such politically sensitive ventures can operate within the established financial system. Now, let's shift gears to how corporations are strategically planning their crypto futures. Get ready for a deep dive into corporate treasury strategies and massive Bitcoin accumulation plans. Corporate Bitcoin strategies: hoarding a digital gold mine. In a move that underscores the growing acceptance of Bitcoin as a corporate treasury asset, Amdax's subsidiary, AMBTS, has successfully closed a $23.4 million funding round. This capital injection is earmarked for an ambitious initiative, acquiring up to 210,000 Bitcoin, representing over 1% of the cryptocurrency's total supply. This strategy highlights a significant shift in how companies are viewing and integrating digital assets into their long-term financial planning, potentially reshaping market dynamics and treasury management practices. The CEO of Amdax, Lucas Wenzing, has been vocal about his vision for AMBTS to become a leading Bitcoin-only publicly listed entity, with plans for a listing on Euronext Amsterdam. This strategy aims to provide a regulated and transparent avenue for corporate Bitcoin accumulation, signaling a maturation of the crypto market towards institutional-grade financial products. Wenzing emphasizes that with over 10% of Bitcoin's supply already held by corporations, governments, and institutions, establishing dedicated Bitcoin wealth companies is a logical next step. This large-scale corporate accumulation strategy carries significant implications for market volatility. When major entities hold substantial Bitcoin reserves, their buy or sell decisions can exert considerable influence on market prices. A coordinated shift in strategy by several large corporate holders could trigger ripple effects, potentially increasing volatility and impacting the broader financial ecosystem. This is a crucial consideration for fintech startups and other businesses relying on crypto-based solutions. Furthermore, the funding of these Bitcoin purchases through capital markets creates feedback loops between investor sentiment, corporate share prices, and Bitcoin demand. A shift in investor sentiment could lead to rapid deleveraging and heightened volatility, posing risks for companies heavily invested in digital assets. This necessitates careful management of investor relations and market perception. Amdax's institutional approach also sets a precedent for regulatory compliance and treasury management, particularly for fintech startups. Companies looking to acquire significant Bitcoin holdings will face increased scrutiny regarding anti-money laundering controls and risk detection mechanisms. Developing robust compliance frameworks to manage counterparty risks and combat illicit finance will be paramount. Best practices in crypto treasury management, such as phased accumulation and transparent reporting, will become essential to minimize market impact and regulatory scrutiny. Companies may also consider strategies like converting Bitcoin holdings into stablecoins or fiat currencies to mitigate volatility risks, especially for operational needs. While Bitcoin accumulation is a bold strategy, the emergence of stablecoin treasuries might offer SMEs a more practical alternative for daily business transactions, given stablecoins' price stability and efficiency. The trend of corporate Bitcoin adoption, exemplified by AMDAX's strategic moves, is poised to influence market dynamics and shape the regulatory landscape for digital assets. As companies increasingly integrate Bitcoin into their treasury management, the future of digital banking and crypto-friendly financial services will depend on their adaptability and strategic foresight in navigating this evolving environment. And that brings us to the end of today's crucial updates. Let's do a quick recap before you go. And that's a wrap on today's essential updates. We saw a financial titan become the top crypto custodian, a deep dive into Bitcoin's valuation versus gold, the political world making major moves into digital assets, and corporations planning massive Bitcoin acquisitions. Don't miss out on what's next. Hit that like button, subscribe to Bitcoin Bulletin, and ring the notification bell. Follow us on all social media platforms for more real-time insights. We'll see you in the next one.